And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is the managing partner of Asset Preservation Tax and Retirement Services. Stewart, good morning.
How are you doing there?
I am doing fantastic. How is your family doing, by the way?
We are surviving all of the quarantines and the stay-at-home stuff, but we're good. We're good. Yeah, kids are starting school here, and it's good.
And how old are they now?
So I've got a 16-year-old and a 13-year-old.
Okay.
And the 16-year-old knows everything.
Okay.
Yeah, he's very smart. He knows more than Dad, of course, and has to let me know it.
All right. So let me ask you: is that driving time yet at 16, or is permit time? What's he doing?
No, he's driving. He's great. Yeah, and it was he's been in motorsports his whole life, so he's comfortable behind the wheel.
Okay, excellent.
Which isn't as scary as my next kid will be, so.
I will never forget the day my daughter first drove herself to school. She's 21 now, but when she was just driving back in, I was like, oh my gosh, it was my baby, but it happened so fast. Well, good, I'm glad to hear that you're all doing great, and I know that your office has been so busy. The feedback that we've received from the shows have been extremely positive, and your calls have been coming in, the appointments are being booked, so you've been quite busy.
I have, at both offices. We have the office, as you know, in Sun City in the West Valley. We also have our Scottsdale office, and they are both, just staying booked.
Yeah, and you have one coming in Tempe as well?
Yep, we're looking at opening an office in Tempe as well.
That's fantastic. So you're just growing all over the place.
Absolutely.
So I wanted to ask you a little bit, Stewart, obviously our show focuses so much on planning for retirement. And one of the things I'd like to talk about is perhaps the importance of diversified streams of income during retirement. What are your thoughts on that? What are some of the diversified streams, and how do you guide people in that direction? Well,
what's really important is that all your eggs aren't in one basket when it comes to retirement income.
Okay.
What we're seeing is, we are the snowbird capital of the world here, and we see tons of clients that come in from the Midwest, a lot of people from Illinois and New York. And what we're seeing are these pensions that are, in Illinois, for example, we're starting to see some of these pensions that have been reduced because they made promises they just can't keep, that don't make any sense.
Sure.
In New York, for example, I have a client that has this 8% guaranteed interest, retirement account. Now, how do you do that in a 0.5% interest rate environment, the lowest interest rate environment in history?
Sure.
Somebody's paying for that, right? So a lot of these state governments that are guaranteeing these rates of return, it's going to be a problem.
Yeah.
And so even though you look back and you say, hey, this is, it's the state that guarantees it. Well, you have to understand what the overall, financial stability of that state is that guarantees it, right? It's just like doing business with an insurance company. If you do business with a B-rated insurance company, what's the promise that they can pay that obligation when they're, when you're gone?
Yeah.
Or when your health insurance needs a payout. So it's really important you understand the claims paying ability of your pensions, any insurance products you have. Super important. But other streams of income, include Social Security, which is where we see huge misinformation, where people will, make a decision without knowing the facts. When it comes to Social Security, a couple can receive up to $1.2 million over their lifetime. And for some people, that's their biggest asset, right?
Yeah.
And they don't even plan it, right? They listen to their friends that saying, hey, Social Security is going broke, so take it early. Well, what are you giving up by doing it? Sometimes taking it early makes sense. Sometimes it doesn't. You need to understand how it affects you specifically and how the combination of your benefit and your spouse's benefit work together. Because sometimes it makes sense to take one at 62, but wait until 66 or 70 for the other. And not everyone can afford to do what everybody else does, right? So everybody's plan is individual when it comes to these income streams. And then other fixed income streams include annuities, right? And once again, annuities are insurance company products, but you want to understand, what is the strength rating of the company that's guaranteeing that income if there's an income guarantee on it? Is it a good company? Am I comfortable with this company handling, this portion of my income for the rest of your life? And you need to really make sure that you understand what is that strength? What are the fees? All of those kind of things that go along with annuities. Some are great. Some are terrible, and you just need to understand, what you have. Other income streams. Sometimes you have to consider whether it's pre-tax or post-tax. I don't think people consider that a lot. What are the implications if I take an income stream from my 401k that I have to pay taxes on versus a Roth? That's more tax efficient because it's tax-free. Does it make sense to have a Roth? Does it not? And you want to make sure that all of the planning that you do, that there's a purpose behind it. Like converting to Roth, for example, does it make sense? It's kind of a hot topic right now, and for most people it does, but how much should I convert a year? If you're at a 12% tax bracket, does it make sense to convert up to the 36% tax bracket? Probably not. Not generally, but you need to understand, every aspect of your retirement plan and whether or not it makes sense to move forward that way. And we're seeing a lot of advisors that will not recommend a Roth, for multiple reasons. One, just remember, and we've talked about this in previous shows, but with a Roth, you have to pay the taxes when you convert it, right? So if you're converting from an IRA to a Roth or a 401k to a Roth, you have to pay the tax bill. And a lot of advisors don't like that. First of all, they don't want to give tax advice. So they're not going to give you any sort of cash flow analysis. But second, just think about this. If an advisor has a $100 million block of business and he tells his clients to convert taxes and they're all at, the 22 or, 32% tax bracket, it's going to reduce what they manage overall because the taxes usually come out of the portfolio. So if their business shrinks from $100 million to $78 million, they've just given themselves a 22%, pay cut. Right?
Makes sense.
And a lot of them are under tons of pressure from their managers to make sure that they perform and they grow their business. And if they go and convert the whole block of IRA business they have, I don't know that the manager is going to be very happy. That's why it's really important to do business with a fiduciary, to make sure that your advisor, whether it's us or somebody else, make sure you're dealing with a fiduciary that puts your interests first.
And Stewart, to the viewing audience who may not know what that term means, can you explain that a little more in depth? What is the benefit to working with a fiduciary?
Well, first of all, a fiduciary is obligated to put the client's interest first over their own. We are not even allowed to receive commissions from other securities companies. So our license prohibits us from receiving any of that. So if we're making a selection of product, for example, or investments, and we see a mutual fund, one that's 1% and one that's 0.1%, and they do the exact same thing, they react identically in the market environment, why would we pick a 1% fee? We're not allowed to receive it. The reason that brokers often do is that they're allowed to receive those back-end commissions. Generally, there is some sort of arrangement. Hey, if you sell, $20 million of this group of funds this year, we'll take you to the Bahamas. And oftentimes, there can be a massive conflict of interest. Or you get to go on stage and show off your buddies at work, hey, I'm number one for selling, this mutual fund. And I think it's really important to put the client's interest first. Also, the concern when we talk about diversified income streams is to make sure, from a fiduciary perspective, that you understand that oftentimes advisors won't go into a Roth because of the tax situation. And the concern with that is that if clients are in an IRA, what happens is we see constantly at the end of their lives, they're 75, 80, 85, and they've got these big IRAs still. They never spent it. Why? Because they're afraid to use the money. They don't want to pay the taxes. And that's
Stewart,
great.
Hold that thought. I'm getting the little cue in my ear that we have to take our commercial break. Can you tell the viewing audience what they can expect to receive by being one of your first 10 callers today?
Sure. So for the first 10 callers, what we'll do is a complete portfolio analysis. We'll show you all the fees. We'll also take a look at any sort of diversification income issues that you have. If you just call 1-833-652-7629, we'd be glad to help.
And please hold that thought, Stewart. With live TV, we don't have that option of cutting and editing. So the number to call once again is 833-652-7829. We know you have a lot of questions for Stewart about planning your perfect retirement. We're going to be right back momentarily.
happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's managing partner of Asset Preservation Tax and Retirement Services. And Stewart, I'm so sorry for interrupting you. You were in such a great train of thought, but with being live TV,
I can't stop. I get fired up and I just start talking.
I know, I love it. And I'm so sorry because it was great information that you were giving, and just talking about the importance of knowing what taxes will be, the implications and what have you with some of the conversions and everything.
Yeah, I think it's just, I think to sum it up, it's just super important to make sure you understand the implications of having IRAs and Roths and Social Security strategies and making it all come together for a very, comprehensive income strategy. I think it really does matter. Yeah. And, like I was saying, when it comes to Roths, I mean, oftentimes, people never get converted over for multiple reasons. And one of them is, the advisors do realize that if you have an IRA that you're going to have to pay taxes on, people will never take those big lump sums out of it because they don't want to pay that tax bill. And if the money is left undisturbed, advisors make more money, right? But I can tell you the whole purpose of saving the money is to have a great retirement. If your goal is just to touch nothing, pass it all to the kids, well, that's one thing. But if your goal is to make sure that, hey, I want to have the greatest retirement possible, I think it's really important to be efficient, because oftentimes when you have these tax-deferred vehicles, you never enjoy it. Sure. And so I think it's important to have a plan to make sure that you understand that you can still be efficient, that you can have a plan. We are in the lowest tax environment in history right now. Yeah. If you don't take advantage of that from a planning perspective, you're missing out.
Sure. Sure. And I love the fact that you just mentioned, is it going to be this or that? You're going to save all this or pass it down. But with you, with the guidance that you give, people can actually do both. They can enjoy their retirement and they can still save money for their children.
Absolutely. And my job isn't to judge your goals. It's to execute them. And it's not about my goals, it's about yours as a client.
Absolutely. Well, Stewart, I want to ask you a little bit more about Social Security, if you will, because we're hearing so many rumors and maybe just frightening information, like, is it going to go away? What are your thoughts on that? Will Social Security one day be gone?
Well, the senior citizens are the biggest voting bloc in America. Yeah. What's happening, and now listen, I was wrong, because, the last administration dramatically shifted the benefits of Social Security. They eliminated the file and restrict. They eliminated the file and suspend options over time. And it was dramatic, and the media didn't cover any of it. So, I always told people in our big workshops, we have 100 people that show up to these workshops when we talk about Social Security. Yeah. And I always said, listen, they're never going to touch it because you are the biggest voting bloc that exists.
Yeah.
But they did, and it was all a big cover-up, right? It was a really kind of hidden move that nobody, covered in the media. But there were substantial changes. But is it going broke? Well, here's the thing. I mean, most people kind of believe in the back of their head that there's something that we need to do dramatically to fix it, and that's true. But what's generally happening is that people who have higher income are just being taxed more. So, originally when Social Security was created in the New Deal, Franklin Delano Roosevelt said that we would never tax Social Security. But believe it or not, it was Ronald Reagan that made it taxable during his administration for the first time. And then Bill Clinton made it more taxable, up to 85% taxable. And the reality is, in my opinion, now I don't have my crystal ball, but what I'm thinking is that as we get deeper and deeper into trouble with Social Security, it's going to be the higher end, retirees that are going to have to foot that bill where they're going to pay more tax. I think it's going to probably be 100% taxable eventually. So it'll be basically treated like an IRA. And but they're not looking at assets when they tax it now. They're looking at taxable income. And what that is, there's something called provisional income. And what that is a calculation of 50% of Social Security plus all of your other currently taxable income. That includes pensions, IRA distributions, any rental income you have, all of your other sort of income added up together. And if you cross certain thresholds, up to 85% of it is taxable. And what we've done as planners is we've been able to look at certain people's situations where we have been able to move people from 85% taxable to completely tax-free on Social Security by just making conversions. Like we look at Roth conversions. There's a lot of tax planning we do, through our tax office that really creates some neat situations. And quite honestly, it makes more sense in most situations to start doing that tax planning now that we're in this super efficient tax environment. Most people believe that we're going to have to pay substantially higher taxes in the future. We've just had these massive stimulus bills. Someone's got to pay for it. We are in the lowest tax environment in history, and if those taxes raise, as most people believe they will, you're going to pay taxes at a higher rate later on in life rather than today. And I think it's important to do a cash flow analysis to see, does it make sense to do Roth conversions? Should I pay some tax on that now? Maybe, maybe not. Everyone's situation is different. It's important to do that sort of analysis.
Sure. Can I ask you, Stewart, are there some common mistakes that people are making when they are claiming their Social Security benefits? Are you finding that people are maybe claiming too early, or what are you seeing? Well,
following that same train of thought about, hey, is it going to be there for us? Is it going bankrupt? A lot of people get scared and they say, listen, we don't know if it's going to be there for us, or actually, I don't even know if I'm, going to live very long. So we're going to, take it out early. At least we get it now. For some people, that makes sense. For some people, it's a horrendous idea, right? Oftentimes, it's important to really kind of play out those scenarios. And we have some very, sophisticated software that plays all of those scenarios out for you. And we graph it. We say, hey, if you take it at 62 and he takes it at 64, this will happen. If you take it at 65 and he takes it at 67, this will happen. And there's no right or wrong. You just have to know what the outcome is going to be ahead of time. If you know the outcome and you know the implications, they're adults out there. They can make their own decisions, right? Yeah. But it's important to present accurate information to make sure clients can make that decision for themselves.
Absolutely. Well, Stewart, we're about ready to open up the phone lines for the second time during the show today. Can you tell the viewing audience what they can expect to receive by being one of your callers?
Absolutely. So if they call in here, the first 10 callers, what we're going to do is offer a complimentary portfolio analysis for everybody. That'll include all of the expenses, all the fees, all the risks that you're taking by being in the market. We'll also do a complimentary Social Security analysis to see what the most efficient strategy is for yourself.
Stewart, thank you so much. To the viewing audience at home, that number to call once again is 833-652-7829. We have to take a very short commercial break, but when we come back, we're going to have more questions and answers for Stewart about planning your perfect retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services.
It's a mouthful, isn't it?
I know, because I was still laughing at what we were talking about over our commercial break, so it took me a minute to come back. But I love this part of the show, Stewart, because we've actually had viewer questions coming in as the phone lines were lighting up. I love that because we never know what people are going to ask. Yeah. So we had a caller that called in, and actually this question is about being 10 years away from retirement. He says, Stewart, I am 10 years away from retirement. I do not have a true comprehensive retirement plan in place. Is it too late for me to start? What direction should I be taking?
Well, the important thing to do is to look at all of your options, right?
Okay.
So oftentimes when we have clients that haven't saved a cent yet, they're working at a company that has a 401k, it's really important to take advantage of all the free stuff that you can get, right? So oftentimes if a client is investing in their 401k at work or not investing, the first thing I'll do is say, what is your company plan? Are they matching? Because here's the reality. I'm not matching anything for you, right? So clients that we manage money for, our company doesn't match it, right? We're not allowed to contribute into your account. There's part of the fiduciary rules. But the reality is that if you can get a 3% or 6% additional value, you want to get that, from the 401ks. Sometimes the best answer for me to give to clients is that, hey, you know what? You have other options that are better for now at your company plan. Sometimes it's the opposite. Sometimes people have money in their company plans, and when they're 59 and a half years old, they're allowed to take distributions very often from those retirement plans to roll them into IRAs, even while they're still working without disrupting their plan. But in answer to his question, no, you've got to start now. You can't just give up. You have to fight. You have to fight the fight. Yeah. If you don't get started now, it's going to be a problem if all you're depending on is Social Security.
Absolutely.
Yeah.
That's a great answer, Stewart. So we also have a question. This one's kind of cute. It says, Stewart, my son-in-law is actually my financial planner. I want to ask you, would it be okay for me to come in and get a second opinion from you? Do you advise this? Why or why not?
Oh, here we go. Okay, so the first thing I tell people is never hire anyone you're not willing to fire. In all cases, right?
Yeah.
Business is business. Because, I'll have clients, for example, that will say, you know what, my financial advisor, he's actually a really good friend of mine. Well, what I'll tell people is, and I listen, I develop those relationships too. But if somebody doesn't do their job well enough, you have to be comfortable moving on, right? It's business. This is your life. Never hire anyone you're not willing to fire. I mean, we have a lot of clients that are financial clients, their kids are advisors because they've just said, listen, I don't want to ruin the relationship. It's hard enough to keep a family together when there's no money involved.
Sure.
What about, and we saw a lot of this in 2000, 2008, where we see these massive corrections. The kids lose half of their family's life savings and because they're in the wrong plan, right? And what do? Fire your kid? it's just don't put yourself in that situation. It's a really tough situation.
Yeah,
and
it is hard.
And, you know, we're in the heart of Sun City, the snowbird capital of the world, in our office in Scottsdale. And we see people that have been with their advisors back in Wisconsin or Illinois for the last 20 years, and they love them. And I respect that. They do their taxes, but they handle the finances over there. You know, and for 2 years later, what'll happen is they'll say, you know what? Jim's a great guy, but it's just too difficult to handle financial services across the country. You know, we want to deal with you locally. You've done a great job on the taxes and the estate planning and all that other stuff. And it's the same thing. Listen, we're in it for the long haul. We are not here to sell somebody that isn't ready to come on board. But people have to be willing to move on if their advisor isn't doing what they're supposed to be doing. And when it's your child, oh my goodness. It's just really, really tough. Don't see too much of that, but you know, every once in a while, it's a problem.
Yeah.
You know, it's generally like the son-in-law or, you know, something like that. And, you know, it's, you know, because he's the smart guy, and then the market crashes and they crash with it.
Yeah.
Don't do it.
Yeah, great advice, Stewart.
My thought.
Absolutely. So, and this is really cute too. This one says, I was one of your first 10 callers, Stewart. What can I expect on my first appointment with you?
So on the first appointment, very straightforward. What we do is try to understand your situation, right? We need to understand all of your income streams. I'd like to see the tax returns as well, to make sure that, you know, you're being efficient, that there's nothing in there that's missing. It's great to bring in statements. We take a kind of cursory view of that. And, you know, what we do is at the end of that, we do the analysis, right? At the end of it, you know, we have some of our analysts do a very complete analysis of the statements. And it's really important to make sure that there's chemistry there, right? Sure. Because I tell people straightforward, I'm not for everybody, you know? And if the chemistry isn't there, you need to find somebody, an advisor, a fiduciary advisor, that you like, that you can get along with, that you can see yourself in a long-term financial relationship with.
Well, because that relationship is so important and the communication is so important. We've talked about this in prior weeks. When someone has a life-changing event, they need to be comfortable enough to reach out to you first.
Absolutely. Yeah, it's absolutely critical.
Absolutely. Well, Stewart, we only have about 30 seconds left of the show. What can you tell the viewing audience they can receive by calling in one more time today?
Sure. So if they call in, what we'll do is offer a complimentary in-office consultation or Zoom meeting with a complete portfolio analysis, analyzing all of the costs, expenses, risks of your portfolio. We'd love to help.
Thank you so much, Stewart. To the viewing audience at home, thank you again for watching. The number to call once again is 833-652-7829. We will see you again next week. Take care.